All right. Hello, everybody. Welcome back to another episode of The Market Close. We are live on this Thursday, August 20th. Thank you, everybody, for being here. We're on time. Got a lot to talk about, a lot to dive into. A variety of things have happened since the market opened, and we will be discussing all of those different things. Chris will be live with Macro Thursday, so we'll have him on in about 20 minutes, and we'll get his perspective on what's going on. Really, it is a macro-driven day because obviously the most focus that the markets have been paying attention to, and that quite frankly, everyone is now forced to pay attention to, are these bond yields. They're not the most exciting thing to talk about, but it feels like that has been the explanation for the choppiness in the market. And the market today, if we had to have one word to describe it, was choppy. We are getting a little bit of a dumpy dump into the close. It was down about 0.5% for the majority of the day. Now it's down 0.81%. So you're seeing that red start to spread into a variety of different sectors. Bloom down 2%, Nebius down 3%, Nvidia has been basically flat all day, Google down 1%, VG has been up because oil prices have still been up, Intel basically flat, Nike's down 2%, Meta losing 5.45. I mean, just throughout the day, you've got some stocks like ServiceNow that are crushing it and are green, up 2%. And then you've got other stocks in the software space that are flat, some stocks in the semi space that are green like SanDisk, other stocks that are flat. Micron also getting a nice rebound. We did have Sanjay, the CEO of Micron, who was live this morning explaining why memory is not a commodity anymore, how it's incredibly important. Stock took a little bit of a dip to the 920s, now back to 967. So it's really been a pick your stock type of day. Bitcoin has also been a winner today. It didn't touch 73. It was very close to 73. Didn't get there, but we're at 72.6, which is not too bad. And I think relatively exciting for a crypto industry that has not seen Bitcoin above 70,000 in the past 2 months. And quite frankly, we got basically a $9,000 candle over the past 48 hours, which is very, very exciting to see. So what was the major headline before we get into everything else that happened today? This happened about 30 minutes ago. Yeah, Walmart, worst day since 2022. We talked about it in the morning. Consumer is struggling a bit. Anthropic, they are ready to go public. There is a 87% chance now in the prediction markets that this company will go public by the end of 2026. So it is happening, folks. Get ready, get prepared. All of us are going to be affected regardless of if you invest or not. The market's going to need some type of liquidity to support this offering. And the interesting thing about this offering is that Bloomberg's reporting that they're expected to beat the size of SpaceX's record-setting IPO, which was about $86 billion. That was the largest IPO in history. I mean, it looks like Anthropic is trying to go for $100 billion is what Bloomberg said. And if that is the case, and they're actually trying to raise $100 billion from the public, I mean, look, there's $100 billion that's out there. The question is, will Anthropic be convincing enough to actually get all of that money? So I think that's also, another reason why the market's just trying to figure out exactly how much liquidity is out there. And in a world in which bond yields are offering you this risk-free rate of return at a astronomically higher level than what Anthropic would have to do to get a return from the IPO. They would have to grow earnings. They would have to prove that they're not a commodity. I mean, there's a lot more risk associated with that. You might have the market start to worry about if that IPO is actually sustainable. So that probably in the next couple months, we're going to get that IPO, which means in the next couple of weeks, like we have to get this S1 coming up soon. And I would imagine then we can actually dive through the numbers and see what's going on. Bloom right there down 2%, Nebius down 3%, Bitcoin at 72,000. In terms of what's been happening with Bitcoin today, a lot of people have been getting liquidated. So this has been the largest 2-day stretch for liquidations of shorts that have been levered in the crypto industry in general. It was the 7th largest crypto liquidation event in history today. 3.5 billion lever positions were liquidated in 24 hours. The crypto market, TAM in general, added about $280 billion in market cap. So that's about 12 billion in market cap per hour for the past 24 hours. It feels like the excitement is back. Hopefully it continues to come back. Apparently there was a decent amount of funds that were short at 60,000, and those shorts are now getting liquidated, getting squeezed, and that is obviously good for BTC. Oil, it was at 87 in the morning. It's still basically at that level, 86.61. That hasn't really calmed down. Basant was on CNBC. We listened to him in the market open. He said a variety of things. We talked about it. Not a lot of stuff that gave the market any feelings of what we're going to be able to do to navigate all this debt as Rocket Lab tries to cross 73 getting into the close. Here's what Basant said with reporters, essentially saying the Biden administration created a lot of these problems.
Secretary, yeah, if you could answer facing the cameras, but for the $40 trillion mark that we passed for the national debt, would you comment on that, and how do we reverse that?
Yeah, look, The 40 trillion is a big number. It is smaller when we look at the publicly traded amount because our Social Security funds and other government entities hold a substantial amount. And what we're going to do, we're going to have to grow our way out of this. And as I talked about at G20 in Asheville, we are going to talk about the U.S. growth strategy and encourage the rest of the world to come along with us. We are also, I announced that Director Russ Vought and I have been tasked with looking at fiscal consolidation. I think the numbers are not the actual numbers now. We've had to do substantial tariff refunds due to the court ruling, but with the Section 301 tariffs, I am confident that we will be back to the same level, if not higher, of tariff income for last year, and that is most of the increase in the deficit. And remember, we did not get here in a day. That we were left with a mess. The Biden administration had the highest deficit to GDP in history when we weren't at war or weren't in a recession. For 2025, we brought it down by more than 1%.
JD Vance kind of had some of the same messaging earlier today as well.
Even though the debt is too high, even though we inherited this debt bomb from the Biden administration, we actually do have a plan to get the economy growing faster than the debt. And that's the most important thing. The issue that we've had under the Biden administration and what we're still kind of dealing with is that the debt was growing faster than American GDP. Mm-hmm. That's the problem. That's something that we're certainly fixing every single day in the Trump administration.
So once again, notice how Vance and Bessent make the same argument, which is that the debt is growing faster than GDP, which is an issue because we obviously need to grow ourselves out of the debt problem, which once again goes back to the stock market. It goes back to equities. It goes back to company earnings. Like if we do not grow ourselves out of this debt problem, we will continue to have a much worse debt problem. And Vance, Bessent, Trump, I mean, they're all making kind of the same point. The big thing that happened today, and I wrote a thread about this on X that anyone can read. The big thing to kind of sum up what's happening is that the United States is in 40 trillion of debt. We need to grow out of that debt, as Bessent and JD Vance just said. The only way to grow out of it is CapEx due to AI. The companies, ironically, that are spending all of this money on CapEx are also competing with U.S. Treasury notes by issuing their own yields. I was actually looking at a bunch of yields today. Oracle has upwards of 8%. Meta has upwards of 7%. Google has a 100-year bond at 6%. U.S. Treasury, 10 years only 4.7, 30 years only 5.2. So when you look at the competition, and Bessent even mentioned on the interview today that he thinks big tech companies funding their AI CapEx should issue 5-year notes versus 10-year notes. Implicitly, he's making the argument that it's competing with the United States Treasury, and that's leading to obviously yields going higher because why would I buy U.S. debt when I can buy Google's debt? And if I think Google is just as safe as the United States government, then I can get 200 basis points above what the U.S. Treasury is giving me. When Chris comes on, we'll talk about this topic with him and kind of get his perspective. But I think that is also why Bitcoin, as it's trying to make a move to 73 right here, has been running kind of the conventional argument that our debt is unsustainable and currency is being debased. And I don't know why today, out of all days, it started to matter. Maybe because the 10-year, because we've been on this fiscal disaster path for the past year, and Bitcoin's been flat. I think maybe the Treasury yields finally waking up is why Bitcoin's waking up as well. And maybe if yields calm down, Bitcoin will come back down. But it also feels like that, along with the Clarity Act legislation potentially coming into fruition, is getting the market to be excited. NVIDIA just came out. They announced that the information report this morning was false. I didn't talk about this because it came out after the market opened, but the information said that NVIDIA is trying to create new chip architecture to comply with U.S. export controls for China. NVIDIA just now coming out and saying we have no China-specific LPU product in our roadmap, and the information report on our company's LPU product in general is incorrect. So, yeah, likely not seeing any of that China revenue coming anytime soon. NVIDIA right there, 216.68. As that continues to be flat on the day. Rock Lab, it's been struggling all day, at least getting a little bit of bounce from 71 to 73. SpaceX also almost went below 130, got held above it at 130.39, now getting a bounce at 134. Can retail investors buy bonds? Yes. We actually talked about this with Chris a couple of weeks ago. Yeah, I mean, there's a lot of platforms that give you access to corporate debt. It's just, once again, a retail investor is looking for growth. If you have a lot of money and you're trying to just generate a return off that money that's competitive with the S&P 500 and don't want to take that risk, then that's the reason you would buy stocks, that's the reason you would buy bonds. But in general, more retail investors want to get access to growth, and that growth comes from actually taking a risk. You can make 10% in a day on Nebius if it has a good day. versus 8% in a year off Oracle's debt. The difference is Oracle debt is not going to collapse on you like this unless the company goes out of business. Nebius could go down 10% in a day, and Nebius was down 2% based on upsizing their convertible note offering from 4.5 billion to 5 billion. Marvell got a nice little pump today as well. You had a bunch of sell-side analysts come out saying that we love this Marvell Google deal. I think it makes sense. Google's saying we think Marvell is worth no less than $207 a share. So you have that kind of baked into the premium, and then you have all the other stuff they're doing with the TPU architecture, the optics space. Obviously, Jensen said they could be a $1 trillion company. I mean, you put all that together, I think it is a pretty compelling pitch for people to want to own Marvell, regardless of what you think about the valuation. And that's why I think it's getting a little bit more excitement for what we are seeing right now. This was Dan Ives earlier talking a little bit more about what's going on with Micron and the broader semiconductor complex. Let's listen to this, and then we'll be closing out the market in a couple of minutes.
The cyclicality at one point will come back, but I don't think you have true equilibrium till late 2028, early 2029, based on the trajectory what we're seeing today. And I think that's why we're going to continue to have these ebbs and flows, no different than we saw with the Kospi and creating some of these sort of white knuckle moments. But the reality, and I think it's further instituted what we've seen from the hyperscalers in terms of demand, what you see in terms of enterprise use cases, memory players, it's right now, it's their world and everyone else is paying rent.
So if the valuation of Micron, for example, on a forward basis is like 6.5, 6.6, something like that. Is that where it should be? Is that cheap? I mean, how do you assess that, given if you're a true believer in what the CEO just said as an investor, then if I agree with you, what do I do? 6.7 times.
Yeah, I think right now, I mean, investors are valuing these companies, this cyclicality, and they're basically giving no credit to what ultimately I believe is going to be the demand over the coming years. Scott, I think it's no different than what we saw like with NVIDIA. You know, if we just think over the last few months, as these companies prove it, the valuation will ultimately then start to I think manifest and actually generate what should be less cyclicality and really more of a multi-year cycle that's going to continue to play. There's no way around it, because even when some say, okay, there could be Chinese memory players or there's an alternative, Korea holds the cards when it comes to memory. And I think that there's no changes that I see in the future.
And there's no implication at all for excess ordering or double or triple ordering because you can't get what you need. And eventually it's going to catch up. And then that's when the problem happens, because people have ordered too much, even if there's robust demand.
Yeah, and that's been a worry. But right now you got to get online to get those chips. And I think part of what we're seeing in terms of everything from a use case, from hyperscalers, from a demand perspective, it's just accelerating. So I don't think that we are near any sort of point of sort of over ordering or worries about inventory and then they cut back. And I think that's something where it's further validated from the hyperscalers.
And you're seeing Micron catch that bid. I don't know why. Kind of feels either technical or, you know, the reason might be Sanjay is going to be on Kramer show in the night, and maybe he announces something new that we don't know about. I mean, he didn't really say anything in the morning that was that new. Marvell and Micron right there. SK Hynix as well. Kind of all the memory names really in the last 15 minutes. Look at SanDisk. Yep, that one also breaking out above 1,600. Getting some love right there. Again, Micron was red at one point during the day, so it's slowly grinded up. Really in the last 20 minutes, you're seeing this breakout above 965 as that is up 4%. Even Reddit, yeah, Reddit also got sold off pretty aggressively today, 144. That was back at those levels it was at a few weeks ago after earnings. And now right back to 150. All right, so there we go. Thursday, August 20th, S&P 500 ends down about 0.84% on the day. Thank you all for being here. The stock market is now closed. Not a crazy day in terms of high beta sectors that sold off. Yes, the S&P is down almost 1%, which is a little ugly, but a lot of the big players of the S&P didn't really feel that type of pain. Amazon right there, down about 2%. Uber was up about 1% on the day. You had Figure that was down about 2%. CrowdStrike, this one continued to take a hit. I think the valuation of the cybersecurity names is just a bit unsustainable right now, down about 5.6%. Your Microns did well, and that helped a lot as that continues to go green after hours. Marvell right there, that was at 251. Put in the chat if you bought or sold anything here, if you took advantage of any of the dip, if you want to call some of these names that were down 2% today. I mean, Intel was down 0.72%. I don't know if that was really a dip, but they are definitely down from where they were on Monday. Rocket Lab, 72.95. That was down about 3.81%. SpaceX was down 4%. Robinhood, she tried to break 100. I think the move from yesterday was just a lot, and I don't think there was enough more momentum for this to continue. Bitcoin probably had to break above 73. Unfortunately, it did not, but Bitcoin's still a massive day, dude, up 5%, 72.6. Again, there's not always a one-to-one correlation with Robinhood. If there's a breakout, it usually goes up, but if it's more consolidating, it doesn't get that big of a move, and I think that's what you saw today with Robinhood, even though Bitcoin had a great day. Nebius right there actually closed at 220. Not horrible. Actually closed at 220. It was pushing below 210 at one point. Meta, 545. That was also effectively flat on the day. Ondas, they diluted by buying a new company a couple of days ago. That's what got the stock down another 5.84% on the day. And then you had Reddit end up recovering all of it, 150.32. Keel, I think, got approval for one of their data centers. That's why that stock was up 3.69. A lot of this stuff has been data center specific to the company. Ren was basically flat, and then Bloom fell below 200 for a little bit, closed above 202. So people saying sold Meta, bought Oracle, bought Circle, bought Reddit, Rocket Lab. Why was HIMS up? I don't know, but this one had a nice day. Well, it was up 7% in the market open, now 2.5% to end the day, but still, at least it got to hold above that that $30 level. Nike, is that green? Nike 40.22. That one ended red as well. We do have earnings. We have Ross Stores. I think that's the big one to look at. Do we have those results? Yes, we do. Is the stock reacting? Ross Stores is up 5. 266 of EPS. Wow, it's a pretty good beat. They beat by almost 40%. Expected was 195. Revenue, they beat by 2%, 6.2 billion versus 6.1. Stocks up 4.8%. Wow, this company's worth 75 billion. Really? Is that more than Target? There's no way. Oh my goodness. Ross Stores is bigger than Target. Oh my, that is kind of crazy. Yeah, there you go. Ross, they sell dresses, right? They sell like back to like it's mainly like kids clothing, women's clothing. And they probably sell men's clothing as well. It's overall fashion, but like discount fashion. Ross Stores right there up 4%. I don't think I've been in a Ross in a long time, but I definitely remember shopping there a few years ago. Revenue of 6.3 billion, up 13% year over year. EPS 2. Oh, they got a 60-cent benefit from the tariff refunds. Dude, these freaking refunds. Basent was asked about those refunds as well. I mean, he just ended up getting mad at the Democratic attorney generals. But these tariff refunds helping these companies beat on their earnings. Market likes it. The tariffs are a form of stimulus at this point for these companies.
Secretary, Neil McCabe.
Mr. Secretary, Target received a $1 billion refund for tariffs. What does that say about the size, besides the fact that it was done so quickly and efficiently, the refund, but what does it say about the amount of Chinese-made goods and foreign-made goods that our retailers are still selling in the United States?
Yeah, well, what it says is that the Democratic attorney generals who filed a ridiculous lawsuit against this administration wanted the money to go back to the payer of record. So that is corporate welfare. The American people had that money. And if I hear another Democratic legislator make the inane remark, the American people should get the money, the American people had the money in the U.S. Treasury, and we were forced to give it back. But using the 301s, which have survived more than 5,000 suits, that we will get that tariff income back. But what you are seeing is that we don't know the discount that Target got from the Chinese suppliers. So, this is a corporate bonanza, which I said it would be at the time.
Secretary, real quickly,
Is a corporate bonanza that you could tell Basent is not really happy about. I mean, because the obvious question is, hey, consumers ultimately ended up paying the excess cost on the tariff. When are we going to get that money back? Or through the cost of the increase on the prices because of the tariff. When are we getting our money back? And obviously, we're not getting our money back. The companies are getting their money back, which maybe they give back to shareholders via dividends and buybacks, or maybe they reduce prices, which is unlikely. But ultimately, this juices up their earnings, which is once again a reason why investors tend to get more of the benefit, as a lot of that stuff ultimately flows to the bottom line. Ross right there, 237. That's up 3.59% as that continues to go green. Target flat on the day. Oracle also was down about 1.2%. Where did CoreWeave end on the day? CoreWeave was down about 1.2 as well. Lost pretty much all the earnings pump. Marvell was the biggest winner today, up 5%. Qualcomm, that's been flat. Broadcom, basically nothing. On Semiconductor down 2. ASML's flat. Intel down 1%. SMCI, even after they got the 5% pump, that faded over the internal investigation leading to no wrongdoing by senior management knowing about the Chinese GPU smuggling. But that stock faded pretty much all of its moves. AMD right there, 469, also flat. And then NVIDIA also flat. NVIDIA's average volume is 140 million shares. Today was 90 million. So as you can see, like, a lot of the market is at this point waiting for some clarity on bond yields, and obviously a lot more clarity from NVIDIA earnings, which is what we're going to have to see when that ends up happening. How did Micron pump so much today? Honestly, I don't know. This was really towards the end of the day. These memory names started taking off. I think it's because Sanjay is going to be doing an interview today. What happened to that Brad Gerstner Sanjay interview that was supposed to happen? That was a catalyst back in June. People were excited about that podcast. That never came out, but Gerstner did end up buying 200,000 shares of Micron. You got the 10-year still at 4.7. But yeah, maybe that's part of the reason why some people are excited. All right, that is what we got. That is what we got from earnings. Ray says, can I withdraw from the U.S. Treasury? I do not think you're allowed to do that. But Basent's basically giving us some of this money back with these buybacks anyway. It's just the market doesn't care. I mean, really, dude, that's been the story all day. This freaking 10-year and like caring about bond yields. Like the last time we really cared about bond yields was April of 2025, because that's when they were spiking enough for the market to actually be concerned. Here's what Fundstrat's Tom Noonan had to say around some of the technicals around this market. But a year later, we care about yields simply because they're spiking back up, and they're not even taking the market down. But it's enough for people to wonder, like, what if this is what cracks the market? And ultimately ending the Iran war would help. But until then, these buybacks that are this artificial level of QE is not really doing the trick right here.
So this was that significant that you think the S&P, the Qs, equal weight leading into Jackson Hole? Like we've got a little bit of room here?
I do think it's a game changer.
Really?
I think we need to see the extent of what they're going to start to buy in terms of securities and how much. And a lot of that has to do with probably the Treasury put, which is now at about 475 for 10-year, potentially 530 for 30. So, in general, it's a hugely reflationary trade that does address liquidity concerns. We saw gold, we saw Bitcoin surge. Near term, the 1-2 combo of rates pushing back up along with crude is temporarily something that stocks don't like. But I think in general, the amount of breadth improvement that we've seen in recent months, along with this ongoing skepticism.
Speaking of yields, Broadcom is looking for $60 billion in their latest endeavors to fund the AI build-out. Wow. I wonder how much of a coupon they're going to give on these bonds. Broadcom's financing may include $30 billion of junior debt, seeking more than $60 billion, discussing guaranteeing part of the senior secured tranche of this AI debt. $60 billion. This is why the market's thinking, wait a second, if Broadcom gives us 7% for the next, 50 years on this $60 billion, or even 5.5%, that's, if we don't think Broadcom's going out of business, that's a better deal than, and Broadcom can't go out of business. None of these companies can go out of business. Like the whole way for us to grow out of all these issues is for Broadcom, NVIDIA, Amazon, Meta, Microsoft, Google to spend. So effectively, if they go out of business, everyone's screwed, which means you can kind of guarantee to yourself they're probably not going out of business. Also, they're incredible companies. But it takes away some money from the long end of the curve in the United States. I mean, that's been the conversation all day, and it looks like, that conversation continues now with Broadcom looking for $60 billion.
Is definitely a positive with regards to stocks.
The messaging alone from Treasury is enough to get us to where you think we can go. I mean, combined obviously with the robustness of earnings, right? I mean, that's the story.
The one big problem was that the velocity of rates had really gotten out of hand on the long end. We saw breakouts on the 30-year, we saw breakouts on the 10-year, and it wasn't the level, it was the velocity of that move.
Yeah,
I think the administration as well as the Treasury noticed.
Yeah.
So my thinking is that they're stepping in now at a time when TLT puts Q is very elevated to say, look, we have to do something to help liquidity. Emerging market currencies are falling. The U.S., of course, has a huge balance.
Blackstone and Apollo are in talks to finance this $60 billion. If the market was afraid, as someone says right here, of Broadcom's demand, I think this is really bullish for Broadcom because this is showing that they have plenty of demand. They're not raising $60 billion for the hell of it. They're raising $60 billion to supply that demand. But Blackstone and Apollo, which I believe were two of the people that Jensen tapped for that NVIDIA $500 billion deal, are in talks to participate in this financing.
They have a ton of overseas securities and emerging market currencies. Meanwhile, the liabilities are in dollars. It would certainly help them to have the dollar go meaningfully lower at a time when growth remains still pretty decent. And that could actually decrease the debt to GDP that everybody's concerned about that now become a big hot button.
Forgive me for interrupting you. It was Rick Reeder who used the word untethered to your point. At the long end. It was starting to look that way in his mind. What do you like best in the market right now? What sector, what area?
Honestly, I like three sectors. I like healthcare, I like energy, and I like materials. I think those three are likely going to benefit.
We'll go back to this in a second, but man, just on a day where the entire conversation is about yields, Broadcom is flat after hours. Broadcom hits us with this $60 billion. I mean, this is quite incredible. I agree with this comment right here. This is kind of why we can't always have a deficit, because for the next 10, 15 years, it is investment time. This is the first time the United States has seriously for, I think in the last 50 years, really invested in ourselves. Usually we, offer services. This time American companies are engaging in capital expenditures. I mean, it's expected to reach 8 to 10 trillion of CapEx by 2030. Like, that CapEx has to be financed, and we need lower rates to finance it. And you can't have the US worried about funding our government because big tech companies are stealing demand for yields on their bonds that investors should rightfully be excited to get. It's just, what does that leave for the US Treasury? Now, again, this is not necessarily big tech versus the US Treasury. We can easily solve this situation. It is not that complicated. The reason the 10-year is spiked up outside of, competing with other assets for yields is because of inflation expectations. We get inflation expectations to come down, this thing is going to fall like a rock. But the only way to do that is to end this freaking war. We don't end this war, we don't get the corresponding sequence of events that leads to the credit markets to just buy up these bonds and get these yields to come down. So now it's like, not only are they buying other companies' bonds, they're freaking selling US Treasury bonds. And again, for Broadcom to raise $60 billion, they're going to have to offer an attractive rate. They can't give you 2 or 3%. Like, I mean, I'd be very curious to see how much they're giving, but it's got to be upwards of 6 to 8%, because that's similar to Meta, Google, and Oracle. Blackstone and Apollo in talks to participate in the chip financing right here. I mean, yeah, it's bullish for Broadcom. It's just, once again, a bigger question for where yields are going. Hiragu, thank you for the super chat. I appreciate you investing in my haircut fund. I appreciate all the comments as well. It's for your entertainment, guys. It's for your entertainment. That's what matters. That is what matters. All right, let's bring someone on to the show who has bought plenty of corporate bonds before, and I think can give us a little bit of insight into what is going on with the US 10-year, what is going on with the equity markets, how they're going to navigate this, what this means for rising bond yields writ large, and also some broader analysis on what Basent said because whatever he did say, the market is not really excited about. Ladies and gentlemen, for Macro Thursday, Dude, he left right when I was about to click. I bet you his mic wasn't working. There he is.
Nah, I just have to start something. Hold on 1 second.
No, you're good. The mic works. That's what matters. Mr. Christopher Patel. We have Mr. Christopher Patel, who is here today. Spotify increasing their share rebuybacks. Did I just say rebuybacks? Repurchase program for $1.5 billion. You got that headline coming across right now. Spotify up about 1% after hours.
All right. Before we get started, we are going to play a game. All right. And it's called Is Amit Good at Math? You should be good at math. It's very simple, but
dude, you're about to embarrass me.
It will help people understand what's actually happening with regards to what percentage.
Did you vibe code this game or something?
No. It's a very simple, just me questioning you and you giving me an answer. Okay. Imagine this is
open.
You can if you want. I don't think it requires it, but imagine right now you are buying a home in the year 2020 and the interest rates are super low, like 2.5%, maybe 3%, right? You're thinking to yourself, okay, let me buy this house. You put down your 20%, let's say on $1 million house. So you put down 200,000 and every year you're paying your mortgage, right? You've got this nice job, you're creating this income, and every year you faithfully pay your mortgage, and then whatever's left extra, you're basically using to fund your lifestyle, right? Or to actually take that money and invest. Now, imagine
to get a good haircut.
Or to get a good haircut. And 2026 comes around and interest rates are like 6%.
Yeah.
Now the bank comes to you and says to you, hey, listen, I need some money. The current bond that I issued you, the mortgage, you're still only paying 3%.
Right.
What if I gave you the option to buy that mortgage back from me, right? Or portions of it. Right. And you could buy it from me for a discount. So let's say I issued it at $1 million. So let's say you borrowed $800,000, right? And the bank says to you, I will let you buy it from me completely for $400,000. So half off.
Right.
Would you take all of your excess cash flow and buy that from the bank?
But that means I would have to now get a new interest rate, right?
No, it's income that's coming in. It's new cash. Yeah. Right? Because you're working, right? Yeah. So why you wouldn't need to get new money. You would just take your existing cash flow and you would redivert it to that, right?
Yeah, that would seem rational to do.
Right? So every year for the next, let's say 5 years, you were just doing that. You would basically go to the bank and says, here's $100,000. You basically extinguish $200,000 in debt. And within 4 years, you don't have a mortgage anymore. Now you have $1 million house and you only paid $400,000 for it. Right. Well, technically you paid, with the down payment, you paid more, but essentially, do you see how that works? Where you can take that long end, that debt that was issued way further out, you can buy it back at a discount. Right. Well, the American government has the ability to print money. They can just go into the ether and go and say, you know what, I'm going to print money. What do? They print money, but they do it in a way that's a little bit different. They don't just go out there and print dollars. What they do is they sell short-term treasuries. So they go into the market right now and they issue short-term debt. Right now, the current
short-term is what, 3 to 6 months? That type of
short-term, like a 1 year. Yeah, 1 year. Like let's say within 1 year, right? You issue debt that's maturing in 1 year. So what do you have now? You've got this capital. You're paying 3% on it. Now, wouldn't it be smart to go out there into the open market and buy up all of that obligation from the future?
I mean, if it would reduce the ability for you to have to pay the excess interest on that obligation, yeah, that makes a lot of sense.
Right? So that is what they're doing right now. They're doing something called, it's a very similar thing to Operation Twist, like back in the day, where what happens is when the long end of the curve gets extra spicy, you want to make sure that the borrowing cost for the country does not start to go crazy, because once that happens, now you've got capital actually chasing after that higher yield on newer stuff. So remember, everything is a competition in the debt world. So if you're offering me 5% and some other guy's offering me 6%, I'm going to go with the guy that's offering me 6%, right?
So let's make
another
it even let's make it even
Right.
simpler, because I think some people are still saying they're a little confused here. So let's just assume the U.S. has $1 trillion in debt. It's a lot more, but it's $1 trillion in debt, and the 30-year on that debt right now is 5.2%. That's what it's. So you're saying we want to issue another trillion of debt for a short term, for 1 year. So
that's
that
only
we can,
3%. We're only paying 3% on that.
We're only paying 3% on that, and we're buying back the bonds that we were paying 5.5% on that
Right.
1 trillion that we already borrowed.
Correct.
This only works because the U.S. can infinitely print money, right?
Exactly.
And that's what they're doing right now because no one's buying our bonds.
It's not that no one is buying the bonds. It's a matter of how do we want to allocate future obligations. So right now, what Besant is doing is saying we need to issue more short-term debt and let us buy back a lot of that long-term debt. And so what happens is your bills still come in every year. So, right. So your interest payments are going to go up, but they're not going to like go super crazy. And you're actually going to basically take down some of that long end of that debt. The challenge is the reason why, first of all, the reason why they're doing it is because imagine right now, the U.S. Treasury is offering, let's say 6% interest, right?
Yeah.
That means that every corporation in America that needs to borrow money to fund growth, to fund capital investment, to hire people, to start new businesses, they're not going to be able to get the same rate as the U.S. government. They're going to have to pay more. So they're going to have to pay close to 8, 9, maybe even 10% if you're brand new. And even some not as reputable companies, they have to pay like almost 12, 13% just to get any money lent to them. So the thing is, when you have the U.S. government and all the hyperscalers spending a crap ton of money and buying, issuing all of this debt, all this long-term debt at the same time, you create yourself a situation where that debt becomes very expensive. And as the debt becomes more expensive, it becomes really, really hard to finance everything. And so what you're seeing right now is people are saying, like, first of all, there's a little bit of a confidence issue in the United States too, because of the $40 trillion in debt, that stuff. But look, when you think about interest rate is all about risk. So if you think that you're going to get paid back in the future, guaranteed, you're going to be willing to, take a little bit less. But if you feel less confident that you're going to get your money back in 30 years, you're going to demand a higher interest rate. So there's two things happening at work here. You've got a combination of fiscal sanity that needs to come back into the U.S. government. So the first thing is we have to get our fiscal house in order. So both the Democrats, they need to understand that we can't just keep spending money on entitlement programs that basically never end. And then the Republicans, we also have to tell them, like, you can't just keep cutting taxes until like you get to a point where it's magically like you're not collecting anything. Everything just works because of magic. Like, both parties are guilty of this. Both parties have to come together and say, look, we need a little bit of entitlement reform, and the Republicans have to stop with this no taxes on anything bullshit. They have to basically gradually raise taxes a little bit. These guys have to spend a little bit less, and then you get your house in order. And that's exactly what happened during the Clinton years in the 1990s, where taxes went up, and at the same time, entitlements got cut, and the border was secure, and you had a surplus, right? Yeah, so essentially, when you start to work your way and you start to get that deficit down, people become more comfortable buying your debt. And eventually,
let's assume that's never going to happen. Let's just assume the next 10 years, there's no way both sides are going to agree to any of that. Can you explain?
The market's going to humble you. The market's going to humble you. Yeah.
So Besant is doing this buyback yesterday of treasuries. Mm-hmm. First of all, can you explain the buyback? Can you explain why he said he would increase the buyback today? And then can you explain why bond yields went right back up to where they were yesterday after he announced it? What is the market not connecting with his rhetoric about what these buybacks could do?
The market is more focused on oil prices right now. They're saying, look, if oil is going to keep going up, that means that inflation is going to go up. And if inflation goes up, interest rates are going to go up, right? So people are more concerned about inflation right now than they're concerned with whatever Besant wants to do. Not to mention the amount that Besant said, like they literally went from 2 billion to 4 billion. You literally have like trillions of debt on the balance sheet. Like, I'm sorry, you're basically like, you know, the house is on fire and you're spitting into it thinking that you're gonna put it out. Like, sorry, dude, the spitting is not gonna help. You're gonna need either a gusher of water coming in, right? Or you're gonna have to get like a CO2 canister and basically fire extinguisher and, you know, take the fire out. The biggest challenge that we have right now is this Iran war situation. Until the Strait of Hormuz gets resolved, you got a lot of issues. You got another problem, which one of the biggest buyers of U.S. treasuries has been the Japanese, right? Well, the problem is the Japanese right now, their interest rates are climbing. Why? Because they have to price everything in dollars and buy a bunch of oil that's super expensive. If they have to keep buying oil at super expensive prices, what are they doing? They're converting yen to US dollar. The US dollar is strengthening. Japanese yen is weakening, right? And the Japanese right now are saying before they used to be prolific buyers of our debt when they were not getting any return on their own government bonds. Now they're getting 2.8%, 3%. And so it's more likely that the largest Japanese insurance companies and banks, they're no longer doing, you know, buying US assets. They're just buying back their own stuff. You know, they're buying their own treasure, their own bonds. So that's
So these buybacks from Besant, you said the market will humble you if and I think you're absolutely right about that on the credit markets in particular. At what point does Besant say, okay, it's not 4 billion, it's 40 billion? Like, what has to happen? How much humbling needs to happen in the credit? Do yields need to get to 5% on the 10-year for them to be like, okay, we're going to step in, you know, we're going to calm it down? Because I think that's what he tried to do yesterday, which is why they got a relief. But to your point, oil prices went up 4% the next day, so the market doesn't care. But how do you think this plays out over the coming months if yields don't stop screaming?
Unfortunately, this is where hard choices are going to have to be made by the politicians. You know, you might have to, I mean, if we start to see 7, 8, 9, 10%, I mean, I know I don't want to see 10% on the damn, I really don't want to see 10%. But one of the challenges that you run into is that you don't theoretically control this stuff, especially on the long end of the curve. You can try to control it, but it's up to the investors. So if the investors like believe that they are going to get crushed by inflation, they're going to demand way more yield. So if they think that 3 and 4% interest is like, I mean, 3 and 4% inflation is like a guaranteed thing from now on, they're not going to be okay with getting a 4% treasury yield. They're going to say, I need at least some money, at least 200 basis points above that. So they're going to ask for, like, let's say 6%, 7%, right? And if inflation goes to 5% because the government has to keep printing money to basically issue more debt, now all of a sudden people are not going to say I'm comfortable with 6% or 7%. Maybe I want 8, 9%, you know? And that's where the spiral goes. You know, we get into a issue with a debt spiral. Like I said, eventually the government will step in my opinion, and both the Democrats and Republicans will say, holy shit, we are in a bad place and we're in a tightrope situation and we need to figure something out. And the president, no matter what he says, you know, I think the Iranians are counting on this. The Iranians are saying, look, this is hurting the US and it's hurting the entire planet. So if we want to get as many concessions out, let's keep playing this Hormuz game, right? And just let the market do its thing. And so each side right now is jockeying to hurt the other person and use that hurt to get something out of it. I think the Iranians are counting on the midterms to be a bloodbath for Trump, in which case he becomes a lame duck president. And so any future attacks on Iran are going to be challenged by Congress a lot more than what they are challenged by right now. You know, same thing with like funding. Like, you know, in order to fight a war, you need funding, right? And who controls funding? Congress. If you don't have control of a Congress, like, what are you going to do?
I think it's also probably why we've seen a little bit of juice in gold and Bitcoin. Let me ask you this question. So Besant says we need to grow our way out of the debt. Big tech is what's leading to growth, AI CapEx. Big tech, in order to get that growth, has to issue all these bonds that are competitive with 10 years and 30 years from the Treasury. So the only way we deal with the debt is by growing out of it. But the way to grow out of it is to compete with our own government on investor capital for debt, because the yield is higher. So is this a paradox that is only resolved if inflation expectations come down by ending the war? And if the war doesn't end soon, which it doesn't look like it's ending soon, like is Meta's bonds gonna compete with the U.S. Treasury bonds? And what type of situation does that turn into for credit markets that are ultimately going to buy something that's yielding more than 4.5%?
I don't know. That's your job to figure out as an investor, right? If you think that in the future inflation is going to be sticky and it's going to stay at a high rate, you need to be long on on assets that are basically going to use that inflation curve to their advantage, like gold and Bitcoin. Well, Bitcoin you can kind of like be a little bit like skeptical of, but gold is an inflation hedge, so that's why you're seeing a lot of people bidding up gold.
Right. This is kind of fascinating, dude. Like the fact that our tech companies need to issue this debt or else they don't have money to buy GPUs, data centers, etc. But because of the Iran war, it's making it competitive with the U.S. Treasury debt, which is supposed to be the safest debt in the world. Like,
I mean, there's a solution that I have that could work.
What, end the war?
I mean, but it would not be good for the markets. You suspend share buybacks for everyone for the next few years, and so all of them are now forced to go in and buy U.S. Treasuries. Like right now, Palantir's sitting on $9 billion in cash, right? Jensen is going to generate $200 billion in cash next year, right? So instead of buying back shares, buy U.S. Treasuries, Jensen.
What do we think? That's a hell of an idea. I mean, as a shareholder, I don't like that, but like it kind of makes a little sense. Like it would be a lot more money.
And then eventually, when interest rates are back lower again, the war is over. Now all of a sudden, go ahead, buy back shares if you want. It's all good.
Okay, if we announce a pause on corporate buybacks in this country, how much would the S&P fall that day? Got to be at least 3%, in my opinion, 3 to 5%.
I mean, it's anyone's guess because then you'd probably
have rest in peace, Apple. No EPS growth at that point.
Yeah, but the thing is, it could theoretically work to. I mean, it would be a pretty bad day in the market, but at the same time, you could also say that now you are getting borrowing costs to come down at the same time. So in the future, I mean, right now, in Apple may be buying back shares and everything else, but if in the future interest rates go to like 8-9% and people can't afford your phones anymore because the economy is screwed, like then what, Apple?
Well, that's the crazy thing about this, and it gets us into this big web that we have to deal with. Like there's a K-shaped economy. Meta is funded through advertising dollars, but they need to get these GPUs to make the ads more effective. So they have to issue debt that's competitive with US Treasuries to be able to get the money to buy all the data center infrastructure they need in order to keep producing these amazing earnings results, which keeps the stock market going up. At the same time, if yields get to like 8-9%, I mean, consumers are not going to have the capital to be able to afford basic things, which means advertisers aren't going to pay Meta if like consumers, get that weak. Walmart's earnings already kind of show the consumer was weak. So to your point, anything the U.S. needs to do to get these yields to come down, the easiest being to end the war, right? I think that would take them down like 100 basis points in a day.
Yeah,
probably is the solution, but as of now, that's not happening.
Yeah, the war is definitely one of the biggest drivers. Now, there are some self-correcting mechanisms out there that no one is talking about, which I think long-term actually work in the U.S.'s favor. So the three main things I think are actually very positive. I don't want to call it positive, but it's just where we are. The first thing is technology itself, like AI, is very deflationary. Like, if it took 100 man hours to do one task and now you can get Claude to do it for you and it only took, let's say, 10 minutes, that's a huge amount of productivity boost and cost savings, right? You don't have to go to the library anymore. You don't have to find a book anymore. You don't have to research an answer anymore. All of that stuff. So your productivity climbs really fast. So technology in itself is very deflationary. The other thing is population growth is basically next to, it's going down significantly. Like demographically, our population is down in a downward trend, right? We're just not having a lot of kids. Net migration is down. What does that mean? That means there's less people competing for houses, less people competing for food, less people competing for, like all the stuff to spend on. So when you have less competition, right, of people what you have is now you have a supply from productivity boost going up, but then
Yep.
at the same time, you've got demand falling. So now you've got deflationary scenario number 2, right? So that's another thing that kind of works in our favor a little bit. So right now, if you look at shelter prices, I put something on Twitter today, and not a lot of people are talking about this, but check this out.
While you bring that up, some more details on Broadcom, guys. It could actually go up to 100 billion. The full package could reach 100 billion, including 60 to 70 billion of senior secured debt, plus roughly 30 billion of junior debt. The financing would help Anthropic and other AI companies secure Broadcom chips. So once again, this would be Broadcom essentially issuing bonds, raising money, using that money to likely invest into Anthropic or give them a line of credit, and then Anthropic would then, use that money to pay Broadcom back to buy their chips.
Yeah. So check this out. So this right here is a map from the New York Fed when it came to housing, right? So and this is year over year home prices. So if you look at January of 2022, when we had, crazy low interest rates, and those crazy low interest rates, people were refinancing all over the place and people were buying houses like there were no tomorrow. So if we look here in the US, all of these places, like the homes were appreciating almost 16.9% in 2022 per year. So if you had let's say a $500,000 house, you just gained $100,000, close to $100,000 of equity in 1 year, right? So that was one major thing. Now look what's happened since then. You can see that interest rates started to climb up. So prices of homes started to come down. And so it wasn't just, oh my God, like homes just fell off a cliff, but look at that nice move.
Wait, so the dark blue is where people are moving, or the dark blue is prices?
No, dark blue is prices.
Okay.
So look what's happening now. Do you see that? And then we ended up here in 2026 in June. Home prices appreciation is down to 1.1% for the entire country. In some areas, it's actually falling. But look at the difference. In 2023, it was 2.7, right? Year over year, then 2.4, and now we're down to 1.1. And it's actually, if you just do a little bit projection out, it's more than likely going to get under 1%. Now, housing, because it's on the stupid owner's equivalent rent nonsense, it comes with a massive lag. And so I think next year, you're going to see home prices actually be a tad bit lower than what they were this year. The amount of inventory is climbing. And so this sort of provides for like an anchor to the inflation narrative next year. But once again, this is all dependent on oil, because right now the consumers are backing away from buying homes. Why? Because they can't afford it. Like no one can afford a 6.5% mortgage right now, especially if you're looking at prices that just appreciated almost 30-40% over the last 4 or 5 years. So people are just kind of like, so the people that are like doing really, really well in this market, and that's why we have that K-shaped economy, is anyone who got a mortgage in the year 2020, sitting on a 2.5% mortgage, you are golden right now. You're basically paying nothing for your mortgage. You're taking that same money from your paycheck and you're redeploying it into the stock market, and you're getting a much better return, and you're not paying anything. The people that are hurting is anyone who wants to buy a house, in which case most people are just saying, I'm not going to buy a house. So the other thing is a lot of the news around the number of buyers, like home buyers, is at an all-time low, the number of buyers. Right.
And
here,
obviously mortgage rates at basically 7 makes it tough, right?
Yeah. And a lot of home sellers, the thing is, a lot of home sellers, unless they're in a position where they have to sell, all they're doing is recycling that home to the next year, to the next year, and to the next year. So what that's doing is that's creating this inventory build. So what happens is you listed in 2023 for $1 million, no one bought it. You're not saying I'm going to lower this down to like 900, right? What they're doing is next year they list it again for $1 million. And the year after that, they listed for $1 million. The year after that, they listed for $1 million, hoping that they get $1 million out. But it's not happening. And so what's happening is the total inventory in the United States, home inventory.
This is also the argument by Gen Z that our parents got rates that were significantly cheaper than what we have to get. And it's why home ownership isn't the biggest priority.
I mean, that's not necessarily true. It just depends on which generation you're talking about. Like, you know, my parents' generation, when they bought a home, this shit was like 8, 9, 10% mortgage, sometimes even more than that. But this was like in 1980s. Okay. In 1980, you buy a house, you're paying 10% on your mortgage. Now, one of the reasons why homes appreciated so much since then is because every year interest rates went down. It became easier to afford that mortgage. And so the home price just kept creeping up higher and higher. Now you've got a different situation where mortgage rates are actually climbing. And so the amount that people can afford is actually going down. The question is, unless you're forced to sell, you're not going to. And so that's why you're getting this very lock-in effect. Yeah, 17% in Norway. So I think we've just been so used to a very low interest rate for a long time that we think that a 5% is high, you know, or a 6% is, oh my God, like 6%. If you ask anyone in like the 1980s and even early 90s, like I got a 6% mortgage, they'd be like, what kind of alchemy is that? Like, there's no way you got that.
Right
now, it's like, oh my God, it's unheard of because we've gotten so used to it. So, but if you look here, like the amount of housing inventory in 2016, there were 1.4 million homes on the market for sale. Right. I mean, this is all seasonal, the up and downs, but you can see since 2022, it went from 350,000 roughly homes to now close to 1.1 million. And then this year, all the houses that don't sell are going to end up going into the pie again in 2027. And the years that are, I mean, if homes are not bought in 2027, those are going to get piled into 2028. And then you've also got to remember new homes that are being constructed. So you've got a declining population. You've got an inventory of homes that are going in the other direction, and you've got new building that's going in the other direction. So you've got yourself a nice situation, especially if your state and local government is supportive of building more housing to actually get lower cost of housing. You know,
look at the house prices obviously were cheaper back then as well.
Yeah, the home prices were cheaper, but look at the interest that you were paying, you know.
So for all of us equity investors, is the conclusion buy things that can inflate faster than the cost of debt, which ultimately is stocks?
That's the other argument that's out there too. Like if the end user feels like they can get a better return in the market, and the thing is the market yields, you know, almost like, especially the last few years have been yielding double-digit returns. You know, you don't have a generation of people who bought bonds ever. You know, you got literally, I don't think I've heard anyone.
I don't even know really how to buy a bond. Like I've never
exactly
bought a bond ever.
Exactly. So what's happening is there's just not a lot of people that are buying bonds other than the institutions, endowments, and everything else. But, you know, that's a good opportunity for retail to be able to buy some stuff that's super undervalued. If you know, if you're looking at certain things and you know what you're doing, you can actually do very well. You know, but once again, this is a time where there's a lot of unknown unknowns. But I think that, in my opinion, had we not done the Iran war, I think interest rates right now, like inflation wise, we'd probably be closer to like 2.2, 2.3 on CPI top line, right? And I think we would have been in a better position, but I think the war really just threw things off, and now we kind of have to like work our way through it. So you've kind of have like two situations. You've got the hyperscalers and AI spending all of this money on CapEx. So that's adding to the fire. They're issuing a whole bunch of debt, which is competing against the U.S. government. So that's not good. And then you've got the U.S. government, which is on a spending binge that they never seem to get off of. That's another problem. So you've literally got like a bunch of stuff going wrong at the same time. And I think eventually the market says, nope, we're not doing this shit anymore. We're gonna hammer you. And eventually the politicians will wake up.
Do stocks have to crash by 10% for this thing to be resolved? Like, could that be a solution here?
I mean, theoretically, that's another solution, but it's not the ideal solution you want. okay? Because that puts you in a very difficult position also. So right now, let's say stocks start crashing. Let's just say some shit happened, credit markets, messed up, confidence goes out in the market, and people just start selling stocks. You've got a reverse wealth effect happening. Right now, I don't know if you saw the statistics. I'm sure that you did because it was on Twitter. The average median portfolio size in the United States, median, is $350,000.
I did not see this. Really?
Yeah. So the
350,000 average median how did they oh yeah, I see it right now. The median value of US consumer stock markets is up to a record 350. 401ks and IRAs are included. Figures more than doubled. Holy crap, dude. Since January, it's up 75%. And it never got above 150 in 2024. This is from Charles Schwab.
So you've kind of have this like wealth effect situation happening also. So everyone who's in the market, and even if you're not directly in the market because you buy individual stocks and you're just basically like, and putting your money in your 401k, everyone's 401ks have done really well.
Yeah.
Everyone's IRAs have done really well. You could just been in any index fund and you would have killed it, right? So if all of a sudden the stock market were to drop, let's say 20%, now all of a sudden everyone's like, oh my God, I'm poor. I better not go out and spend money. I wanted to get a new car, but fuck it, I'm gonna settle with just using my beater for another couple of years, right?
Dude, and all of us, I know all of us I don't care how big your portfolio or how small your portfolio is, on a red day, you have that feeling where it's like, I don't really need to order sushi. Like, I felt it before, dude. I'm like, it's like everyone feels it. Yeah, and if that happened on a scale where we actually see the S&P like really take a dip, yeah, you're right. We're gonna stop spending.
And if people all at the same time stop spending, we get a Walmart, right?
Yeah.
Walmart's like, holy shit, like I'm not seeing as many customers. Why? Because things are coming down. Now, Walmart tracks more of like the lower end of the K-shaped economy, right? So what you're seeing right now, even if you like go to like restaurants in New York City, they'll tell you like the lower end restaurants are not doing well, but the high end restaurants, bro, they're packed.
I've heard this before.
Packed.
Yep.
So that's where we are.
Yeah, because I mean, if you are wealthy, you're not gonna. I mean, Ambassador's Clubhouse, it's one of the best Indian spots in New York City. They had 100,000 people on their wait list, and it's like it really, but like it's like if it's at that level, people will pay whatever. They'll pay 5,000 to book a table, right?
Yeah.
Whereas you look at regular size restaurants, like, well, those are the ones that are struggling because they're not going to get people to pay that type of excessive premium.
Now, here's the problem that you run into. You know what this breeds? Socialism.
Yeah.
People see that there are people out there going to crazy restaurants, eating steak every night, getting $100 haircuts, and then they're out here working 9 to 5, 3 jobs and barely surviving. You're really going to tell that person that, I can't fix your problem by making the guy above you poor? I'm going to raise taxes on that guy, bro. If I was working a minimum wage job, I didn't have anything. I'd have kids that I got to feed. If someone was able to throw me a lifeline, I would not go and be like, yeah, socialism is bad. They'd be like, socialism all the way. And so, you're seeing a lot of people get duped into socialism because of that.
My haircut is $40. Okay. Maybe that's why my hair looks like this. But yeah, dude, it's really interesting because this K-shaped wealth effect, if that fades and that goes with the stock market, yeah, you're right. Now, the earnings growth doesn't slow down for these companies, though, at least the AI CapEx companies, but Target, Lowe's, Walmart, Home Depot, those are the ones that really feel it. And those are still a big part of the S&P at the end of the day.
Well, the hyperscalers will feel it too, because remember, their other part of their income comes from what? From ads, from all the services that the other companies buy, right? So if Home Depot right now is running ads on Google and Meta and everything else, right? And they see a drop in, demand, and they're basically losing money. What do you think they're going to do? The first thing they're going to do is say, maybe we don't need as many ads from Google. Maybe we don't need as much marketing spend on Meta. And so what happens to earnings for Meta? Socialism is how you end up with hair like Amit.
No, you're right. Okay, so what do you think is the quickest way that Trump can resolve this?
End the war. It's pretty obvious.
So what is your take then on Besant's argument this morning, which is we're not going to go back to kinetic military operations. We're going to try to use economic sanctions because, I mean, we've had sanctions for 20 years. Like, I'm surprised this is their new approach to getting Iran to the table.
I mean, bombing them, it's clearly not working. These people, they live for that. You know, their martyrdom is part of what these guys live for. You know, especially in my opinion, the fundamentalists that are really big ideologues, they want to be martyred. They want to die for this, you know, cause that they think is just. So, you know, you're basically giving them what they want, right? Now, on the other hand, by economically going after them, what you're essentially doing is putting them in a position where their own people are going to struggle. I mean, if you look at the inflation rate in Iran, it's insane. You've got a populace that's literally always on the edge of revolting on these guys. So what's going to happen? So the conditions are going to be terrible for the Iranian people. But I think the U.S. kind of wants that a little bit too, in saying, look, if we can't dislodge these guys anymore, so you have to dislodge them yourself, or at least put enough pressure on them to come to the negotiating table, you know? Now, the thing is, the Iranians are very like the IRGC. Let me not say the Iranians. Iran, the country and the people are different than just a plain IRGC. Like, we have to kind of put those two things in separate buckets. So I can't just say the Iranians. The IRGC wants to maintain power because they know if they lose power, they're going to get Gaddafi. Do you know what happened to Gaddafi?
Yeah, his people killed him, right?
Well, his people killed him, but they shoved a freaking stick up his, you know. None of these guys are trying to go down that way. None of them. So their thing is they're in survival mode. The IRGC is in survival mode. You've got some parts of the IRGC that are a little bit more moderate, but then you've got like the hardcore fanatics. They're like, we don't care. We're willing to die. And actually, I saw in the Wall Street Journal, these guys want to expand the war now via proxies in Iraq, in Kuwait, in Yemen, right?
They've already been doing that partly for the past few months.
Right. And they're doing it more so now because they think that they've got leverage over the United States. So each side is kind of in this situation where, you know, I don't even know how to describe it, but one of the things, in my opinion, that this reveals overall is that the United States really needs to get a control over its fiscal situation. If we are going to war with Iran and we're dealing with all this other bullshit in our economy, that's not good. That means that we did not have our shit in order to be able to like do a prolonged war situation, right? Yeah. The reason why the Iranians are in a position of power right now is because we are economically in a bad place. Now, there's one good thing that's coming in like the next couple of years. So the first thing is the UAE has been building another pipeline. So you've got a little bit of relief from that. You've got the Iraqis now probably going to be able to do a pipeline through Syria. And so you've got that alternative coming. So the US now is producing like there is no tomorrow. You've got Venezuelan oil that's slowly reaching the markets. You got oil from Guyana kind of reaching the markets. Then you've got the US like escorting ships on a nightly basis, shipping oil through the strait under the cover of darkness.
Do you think there's a world in which the Strait of Hormuz is irrelevant in a few years because there's so much production and so many different routes, and that's the new plan?
I think so.
But then do we just wait it out? Is that the solution?
Well, I don't know. That's the thing. I have no idea. You know, but you have to have a backup plan anyway. Like, there's no way that you can just say, "Oh, we're just going to be complete." Like, even in future terms, like, you really want the Iranians 5 years from now pulling the same shit again?
100%. No, you can't. We can't afford for Iran to do this again.
You can never let the Strait of Hormuz become a choke point ever again. So even if, let's say, you negotiated a deal right now for the next like year, 2 years, and you got flow coming through, the world would be stupid just to go back to status quo again. I think the Iranians also know that. So they're more likely to negotiate with us, but I think they'll probably negotiate after the midterms. Like right now, I think the Iranians are in this position where they're like, we need to neutralize Donald Trump and we need to neutralize Donald Trump's power in the United States. And the way that we're going to do that is by making sure that the economic sanity of this country is challenged and people blame Trump, which, to be honest, he kind of deserves the blame. You know, I mean, at the end of the day, he's the one accountable for going into this war, right?
Right.
So, you know, this is, like I said, this is a lot more politics, gamemanship here and there. But I do think that if the midterms come and the Democrats, which I think they'll probably take the House, but if they also take the Senate, I think the Iranians are more likely to negotiate with us for a more lasting deal, because even that's ultimately their goal at this point. Make Trump a lame duck president and basically make it so that he can't necessarily attack Iran without at least some level of accountability from the U.S. Congress.
Why did Trump give up his attempt to take over Kharg Island?
I think the amount of death that we would have, like, you would have basically been committing soldiers to be on Kharg Island and then putting a giant bullseye on them. Like, Kharg Island is right there. Like, the Iranians could literally park missiles and drones right there, and any soldier that was on Kharg Island, they would literally be facing attacks all the time. And the last thing you want is, you know, is like planes full of body bags coming across, you know. So the Iranians have a very strong position on Kharg Island, no matter what we think. Now, yes, Kharg Island is their lifeline, but at the same time, it's kind of like, this is like a chess game, right? Where you have a piece on the board where if you try to take it, you're going to lose something in return, right? It's not as simple as I'm going to take your rook and no one's going to, you know, like that knight that basically took that rook is going to be chilling. Like, no, if you're going to lose that knight also, then you're in a weaker position. So this is a game of chess right now. And everyone is looking and saying, what can I take from the other side? Like, where are they weak? Where am I strong? And also remember, just like chess, you're playing with a timer on both sides, right?
Yeah.
Like each side has a timer. The US, the presidential midterms is their timer. The Iranians, their economy and their people uprising is their timer. So that's where we are in all of this, man.
Do you think Besant was saying all of our allies are going to come together to have the most pressure Iran has ever had economically? Iran doesn't care about their economy, obviously 80% inflation. Do you think, as you said, they're going to wait it out even with that pressure until he becomes a lame duck? Or could that pressure actually become so intense that they agree to whatever terms are in the deal?
Fortunately, the order which the administration did this was wrong. If, let's say, the administration had gone to all of our allies first and said, look, we really need to stop this nuclear Iran. They clearly export proxies. There's evidence all over the place that they support proxies in Lebanon, in Yemen, in Iraq, and they destabilize the region. You got a regional block of people, even in the Middle East, together and saying, let's isolate the F out of them and keep that isolation until they are they're basically subdued. I think it would have been a lot more effective. That's what Obama did. Obama said, let's isolate them. Let's put them in a very difficult position, and then have them come to negotiating table to us. We did not inform our allies, you know, and we went in and then we asked them later, like, hey, listen, like, do you mind helping us? And our allies said, listen, bro, you're on your own on this one, right? We don't have the popular support to back you. And so right now, even if, let's say, the U.S. was able to exert pressure economically, our European allies and everyone else, they're not in a very strong position to be able to do that.
A lot of them never wanted this in the first place.
No, they didn't.
Right?
You also have to remember that they are in a position where I think one of the things, and maybe some of the Europeans in the chat, maybe you guys could chime in. I think fundamentally Europe is going to transform and become a lot more, it's definitely going to lean a lot more conservative over the next probably like 5 to 10 years. And the reason for that, it's because of a combination of things. Number one, a lot of the green policies that the Europeans adopted, while they're good policies, I think they were done way too quickly. And I think the average person is feeling the weight of that because the cost of living is dramatically up, right? You've got opportunities in Europe not as good as they were like when their parents were around. You've got a lot of migration there that's culturally very different from the native culture, and so you're seeing that culture clash. Like I'm of the belief that immigration is good as long as there's a level of assimilation that happens alongside it. But if you have like unlimited amount of migration, and then what happens is people create private enclaves, and then their culture becomes like the dominant culture in certain parts of your own country, there's like a visceral reaction that comes out of like the native population that's just like, I've never seen, like, just as an example for us, I've never seen more Indian hate now, like, in my life.
No.
Like, I'm talking about, I saw less hate after 9/11 than I'm seeing today.
No.
You know, there is way more hate. Now, the thing is, like, one of the reasons why is because Indians, I'll be honest, you know, there's a lot of Indians that came over the last probably like 10, 15, 20 years. So because of that, we're a lot more visible. You know, we're a lot less likely to basically assimilate. Like, one of the things, and I don't know, maybe you can chime in on this. I've gone to like to Edison, right? Like, Edison is like the capital of Patels.
The grocery store is called Patel Brothers. Like,
yeah.
Edison is the capital for Jersey
now,
Indians. That's correct.
Now I'm a Patel, okay, and I get to be critical of my own people. One of the things I hate about going to Edison when I was there is some of the stuff that these people do. They do it like they treat their own environment like it's country back home. They leave shit on the ground like it's a little bit dirtied up. You know, people like, you know what Manik Chand is, the beetle nut that they all chew. They're spitting that shit, and you can see it in Edison. I'm like, don't fucking do that. Like, that shit is disgusting. Stop. Like, even Indians like myself, we hate that shit, you know? But the thing is, like, my generation, we understand that. We don't bring a lot of that to here. But the thing is, if you let, like, an area become way too Indian and way too many people of that culture, you kind of get, like, the bad parts of that culture, and they don't assimilate to the culture here, you know, and that culture. And I like, the best example is my mom. My mom, like, one time I was like, hey, Mom, do you want to, like, you know, live here, blah, blah, blah. And she was like, no. And I was like, why, Mom? She's like, there's too many fucking Indians there. And I was like, wow, Mom, you're Indian. She's like, I know.
My dad is the same. My dad is actually the same. It's funny. You tend to be more critical of your own kind. And obviously that's been happening more and more. If the Europeans tend to get a bit more conservative, as you're saying, do you think that's good for the U.S.? Or is that more competitive with the U.S.? Like, does that help American companies? Like, you know, Canada was trying, like, I don't even know if news from Bloomberg is still available on Instagram in Canada because they banned it. Like, if that stuff starts shifting to more free speech and stuff, do you think that's ultimately in our interest as Americans?
I think Europe has some of the smartest people on the planet. I think they have some of the best education on the planet. I think that they have the ability to actually do better than the United States if they were able to adopt more, like, capitalist policies. I think socialism, even socialism light, has basically drained the Europeans out of a lot of opportunities. And that next generation that's coming up, they're sort of waking up to that idea and saying to themselves, like, wait a second, maybe the policies that we've had for the last 10, 15, 20 years, maybe they don't work for us, you know? And I don't know, like, I think capitalism is the best way for people to get out of poverty. I think the pursuit of, you know, entrepreneurship, you know, developing technologies and basically selling to the world. I mean, you know, the Europeans, you know, the GDP, like, on a per capita basis of a lot of European countries were in the year 2000 was on par with the United States.
That's right. You're right about that.
The same buying power that a German had, like a German, like, worker had in the year 2000 was the same as a US person. So on a GDP per capita basis, it was the same. Since then, the German, they've basically stayed roughly the same in terms of total buying power, and the United States has actually doubled. So it's not cool. You know, it's like it's that uneven growth. Now, here's the thing: as a U.S. citizen, yeah, baby, I want all that fire. You know, like I want to live in that country that benefits tremendously. But you also kind of want to have a little bit more equality around the world as well. You know, you can't just have like one country be like the richest country on the planet, and then the rest of them are just poor, struggling, barely making it. You know?
Do you think the Japanese would sell U.S. treasuries? Or would Trump be like, there's no way in hell you guys better think of that because we're the ones trying to stabilize the yen in the first place?
I think the Japanese are going to do what's best for the Japanese. I mean, you know, like, yeah, it's just that's their mandate, right? Like you as a Japanese like person, politically, if you see that, you know, your country is basically a vassal state of the United States, you're not exactly going to be like cool with that. Right. So on one hand, if you've got rampant inflation in Japan and the Japanese are just basically buying U.S. treasuries, you know, and basically ignoring you, that's not a good thing. Right. So,
yeah.
So I think overall this thing will eventually get resolved. I have a feeling that we could see a blue wave sort of situation that we saw like in post like when
let's do a poll right here in the chat. So this is not who you're voting for, or if you're European, if you can't vote, but who do you think wins? I'm gonna do that same odds, whether it's red sweep, blue sweep, or half and half. What do you think it's gonna be a Dem sweep across the board?
I want to say no, but I know that there's a good possibility. Now, the Dems, they have their own shitbags in their party that is really hurting them hard, man. Like, there are these Hassan Piker DSA socialists that make it extremely difficult for even like the moderate Democrats to be like, man, I gotta vote for this guy. You know, that's the other problem.
AOC has already started disassociating with some of that part of the party because it's just impossible to galvanize a coalition when you have too many extremes. Same thing on the right.
Yeah, exactly. So if the Democrats didn't have that idiot or that part of the what is that called? The part of the party on their side, or at least they weren't as prominent as they are right now in terms of like their presence, I think that the Democrats could sweep. But I think there's also this part of like a bunch of like really old school Democrats that still have power within the party that are saying like, I would rather have a Republican than have a socialist.
Yeah, I think the extremities of this are interesting because if you're running to be a Democrat, you have to do Hassan Piker's stream. Like you can't, if you're the Democratic nominee, I mean, unless you're like Newsom, he might not do it. But if you're like a Shapiro or an AOC, you completely isolate that part of the party. I don't know. I wonder if you're giving up some votes.
You know what's kind of crazy? Like these DSA people, they're openly come out and they're saying our enemy is not the Republicans. Our enemy is the Democrats. Yeah. I was like, damn, you guys are vicious, man. You know?
Okay, so these bond yields aren't coming down anytime soon. Oil prices are not coming down anytime soon. Midterms, who knows what's going to happen there. And then you've got artificial levels of QE happening from Basent. What do you think happens over the next 3 months then? If you had to guess, knowing that this is typically the midterm slump and that we tend to bottom in October historically, like, do you think it plays out like it has since 1949 for the midterms, or we just grind higher?
I don't think we've ever been in a situation where we've got so much like uncertainty on either direction. Like, we don't know what Trump, like this president has been one of the most predictable and unpredictable presidents ever in my lifetime. And what I mean by that is, I know there's a certain threshold of pain Trump will literally be okay with, and then he'll basically taco, right? Like, we all know that's going to happen. The question is, where is that taco going to happen? On the other hand, you don't know what Trump is going to do next. You know, like, he could say, like, let's end the war with Iran and then go right back to, we need to invade Greenland again, and we need to turn Canada into
Dude,
the 51st
this
state.
year has been so crazy. I forgot the Greenland thing even happened. Did anyone? Was that last year? Was that this was? No, that was March of this year. I remember that. I was having lunch with Steve that day when the news came out, and I tweeted.
Remember,
like,
Canada was gonna be the 51st state.
Yes, that is well.
And now,
and now he took off the tariffs yesterday. Yeah.
Yeah, and then he was like, "Oh, 50% tariffs," and then he took it off, and now he's like, "Oh, we're gonna tariff." I think who was it? Like, I don't know, bro. I don't know what the hell is going on. Just, I don't know.
Yeah, it's kind of confusing to see how the next few months are going to play out. And the problem here is it's not like stocks are only up 2 or 3%. We're at all-time highs.
Yeah.
Like, as annoying as some of the semiconductor consolidation has been, Nebius is still up a lot this year. So is Micron. So if we're at all-time highs, you kind of need really good catalysts to push us higher, right? Or good macro stuff, and we're not getting a rate cut. Like, I don't think you think we're getting a cut this year.
No. I think one of the things that even I got sort of like wrong, I did not expect the level of CapEx increases that we saw. Like, it's just crazy to see. And what that's done is take all of this liquidity and put it into the market. And so if you look at the earnings estimate, like for the S&P 500, they've been revised higher and higher. And every quarter, it's like, it's here, and here. Yep. Now it's like, what the hell is going on here? But the thing is, all of this is because there's just so much liquidity sloshing around the system, and it's all being fueled by debt. The problem is when you become so used to that growth rate, that means that you have to maintain that growth the year after that, and the year after that, and the year after that. So the challenge is, at some point, if that growth starts to come down, you've got to reverse situation happen, right? So if you look at like the Shiller PE is at next to all-time highs, very similar to the dot-com bubble. But if you just look at it from a relative earnings growth, it's actually not that bad. Like, if you look on a forward earnings basis for the S&P 500,
it's kind of
we're actually okay. It's cheap, right? But that's on a forward basis if next year's earnings are what the market is projecting them to be. If something happens and let's say there's a cutback on CapEx and then everyone else starts cutting back on their spending, and you've got the market coming down and people, so earnings could fall. Or at least earnings growth could come down, in which case now the S&P 500 goes in the other direction. It feels like we are getting closer than not to Trump capitulating in some meaningful way, because he hasn't in a long time. This entire thing, I think the entire macro picture right now is all dependent on OpenAI and Anthropic. That's it. Like, bro, that is like...
So let's end off on that conversation. So you got pretty freaked out by the numbers that happened with OpenAI. Anthropic said they want to raise $100 billion today, more than SpaceX. I mean, can the market afford these two IPOs right now?
I don't know, dude. This is where I don't know how Anthropic could probably justify their CapEx, because if you look at their long-term commitments, they're not nearly as bad as OpenAI's. OpenAI's long-term commitments are in the trillions, and their growth is nowhere near what we need them to be right now in order to justify the spend. So if OpenAI's numbers don't look right, and if they can't raise enough capital, I think the market is going to get spooked and saying, whoa, wait a second. What do you mean? Like you guys might not be able to pay for this future compute obligation.
But don't you think, I know the Q2 growth wasn't that good, but July had GPT 5.6. CFO said all of July was better than all of Q2. Do you think there's a little bit too much worry for something that is scaling, just not as fast as people thought?
I think the problem that you run into is that I think a lot of these commitments were made prior to Anthropic becoming as big as they are. And I think OpenAI is in a really bad place, because the thing is, if you think of yourself right now, you've got the best product. So you're like, screw it, I'm going to commit to crazy amounts of future obligations. And then someone else comes along and they have a better product than you. And now all of a sudden you're like playing second fiddle. You got a problem on your hands, because now you're not as competitive as the top guy, and you now have to do things that basically make your business not as good. Do you think OpenAI wanted to reduce their token cost by 80%?
No.
You
Not
think
at
they
all.
were like, hey, listen, I think we're such a great business that we can't maintain our current pricing structure, right? The other problem now is that OpenAI lowered their cost by 80%. People are switching to Codex, switching to all the OpenAI stuff. Now, all of a sudden, Anthropic is probably going to have some growth problems, right? Because they're like, shit, all these people are switching to OpenAI because they're offering lower prices. Now, Anthropic is in a position where they have to lower prices. And so what happens is you've got competition. And if you read 0 to 1, what happens in 0 to 1? Competition destroys margins.
Yeah. Competition is for losers. What do you need to see in the S1 personally as an investor? Forget the numbers. What do you need to see from a trajectory perspective? Let's say the numbers are good, but like realistically, you want to see what the company's vision is.
Durable monetization.
Yeah, because the numbers could be
Durable
good this year, but if the numbers are not good in 5 years and there's no path to keep the numbers good, then what's the point of investing?
Yeah, you need a durable monetization model, right? Like one of the reasons why SpaceX was able to get this crazy high valuation, in my opinion, is because they were able to say, look, we've got space data centers coming. Whether they happen or not, it doesn't matter, but at least the investors believe in it, you know?
No.
So OpenAI and Anthropic have to come up with a way to project that they have the ability not to be a commodity provider, but to actually be like a durable infrastructure player that has like repeatable revenue does this. Okay, you want like revenues to basically just go like that. And I think that's the challenge that you're running into. And that's where Alex Karp and all of these guys, they're looking at OpenAI and Anthropic and saying, your margin is my opportunity. Why? Because OpenAI and Anthropic have to charge crazy amounts of money and get crazy amounts of token use. So Palantir is coming in and saying, if we can basically enable your business to do what you need to do, and we can do it at, let's say, at 20th of, like 1/10 of the cost or even 1/5 of the cost, you're not going to go to these guys. You're going to go to me, right? So they see all of this high margin revenue, supposedly high margin revenue, and they're saying, I want a piece of that because I get to make money off of that. DeepSeek is seeing the same thing and saying, we create models and more people use our stuff and we make money.
So $2 trillion for Anthropic. If a retail investor is curious about buying the IPO, outside of durable monetization, what do you think they should care about? Like they've got to assume it's going to be a $10 trillion company, right? Or at least a $4 to $5 trillion. Otherwise, why are you buying it?
Exactly. And I think because retail investors, a lot of them, they don't look at those things, man. They just look at, oh, look, I use the product every day. I love it. I'm going to buy some shares in it.
That's how a lot of people are probably going to buy the stock. I agree.
I
agree.
I mean, a lot of people bought SpaceX because of the Elon premium, right? People didn't look at like, oh, what's the monetization now? What is it 2 years from now? Elon Musk says they're going to be space data centers and robots. That's where we're going to make all this money. Okay, buy the stock.
Yeah, I think it's going to be fascinating. If they end up raising more than SpaceX did with the Elon premium, I mean, every time I think of Anthropic, I'm like, why wouldn't I buy more NVIDIA? Every time I think of SpaceX, I'm like, that the exclusive partner is NVIDIA. Why wouldn't I buy more? Like, it's really tough in my head to be like, okay, this is way more alpha. Because if Anthropic goes from 2 to 4 trillion, like with these token costs that are collapsing every day, I mean, I would imagine NVIDIA is probably going to be higher than 5 trillion. Maybe they don't get to 10 trillion like that, but all of these companies' growth, it all comes back to NVIDIA.
I mean, if you ask me, I think NVIDIA's moat is more durable than OpenAI and Anthropic's is.
Yeah.
You're basically one part of the commodity layer. You ask anyone, like I would say, talk to Chad. He'll probably tell you exactly.
Speaking of Chad.
By the way, he unfollowed me. He unfolled me.
Talking all that shit on Palantir. He's gonna unfollow.
No. What happened was I messaged him on X, right? I said, yo, you need to get that customer count up, bro. That customer count is gonna end up.
Why would you message someone at Palantir after the best earnings in history about this one detail that you don't like? I would have unfollowed your ass too if I'm Chad. Goodness gracious.
Bro. You gotta get that customer count up, bro. Come on, man.
Chad's
You
basically like a C-level executive at Palantir, bro. He's not
I
C-suite.
know.
But
He's a good guy. He's
He's basically C-suite at Palantir. Like he's that
I know.
close, to it.
I know. No, he's a good guy, man. He's a good guy. But no, I'm in agreement with Carp in trying to say that, you know what, we cannot have a situation where there's two model companies and they basically extract value from everybody.
Yeah.
And the thing is, like, you don't want to have two companies have that monopolistic power over the US economy either. So yeah, alternatives will come around and we'll see what happens.
Speaking of Chad, he's gonna be on Basis Points tonight. So
congrats. Nice.
Yeah, we'll have him on. That should be fun. I'll let him know to refollow you. He'll be like,
he doesn't have to. It's fine. No, look, you need that other guy. You need that asshole to keep you motivated. I know everyone in the Palantir community hates me, but I also keep them like, fuck. We gotta stay ahead of Chris's criticisms.
That's fair. That is fair.
So listen, if in the next couple of years you see like the number of customers skyrocket, be like, fuck, man. Everyone will dunk on me. Everyone will be like, look, Chris, you idiot. See, like the number of customers grew by like 50%. Ha ha ha. And I'll be like, okay, whatever. You gotta have someone to keep you motivated to do the next thing, right? So.
All right, folks, that is it for us today. Chris, I think it was a really good explanation on these bond yields and what's actually happening with the cost of capital in this country. And hopefully we get the resolution, but if we don't, I think we're going to continue to be stuck in this consolidating, potential choppy market that we're having right now.
We're not going to mention SaaS, the SaaS comeback.
Oh, yeah. So first of all, there's Chris's X. We could end off with that. ServiceNow, I mean, you got to be having a good day. I don't even know why it's up so much because the other SaaS names are kind of chilling, but getting a little bit of a breakout here.
Dude, all of SaaS. I've actually started to see research now. All these companies are hiring the software engineers back again. This bullshit. Yeah. Because they realize that there's a certain level of like thing that AI can get you to, but you still need that fine refinement part that like the end user has to, like, you need to have in order to actually make this stuff work. Right. Vibe coding was nice. I think that there is a place for vibe coding to help people, but I think what people are noticing is that you actually need more software engineers to babysit these AIs, to make sure these AIs are not running loose. So yes, your productivity is going to go up with AI use, but you're also going to have that person babysitting these things, making sure that they're correct. I'll give you an example. Grokbot. Have you tried it yet?
I have not, but I've heard good things.
Grokbot is awesome in its functionality, but you need to keep an eye on it because it still gives you a lot of false positives. And especially if you're in an industry where you need accuracy to be the main value, you can't just let Grokbot be your guy. You need to have this is true. All job posts I see are mostly software devs. Unfortunately, not many tech managers and leadership. Absolutely. You need to know people who are actually in the nitty gritty because what are you going to do? Claude, I've been hacked. Please help me, find me my vulnerability and help me fix the bug. Nah, it's not going to work. You need Chris Patel to go into the application server, look at the logs and say, okay, what could be the problem? And then
do you really need Chris Patel to do that though?
Not really. But the point is, I need to justify my job, right? So I'm gonna say it. But the point is, this is where you are in all of this.
Yeah. Are you selling ServiceNow here? Taking some profits?
Nope. Let it do its thing, bro. I think the narrative is finally dead. The company is clearly a compounder, and it's not just ServiceNow. Intuit, Adobe. What is that thing called? Salesforce, HubSpot. All of these guys are recovered almost 50% from their lows.
Yeah,
right.
Yeah.
And I think this trend is going to keep happening. Look at Atlassian. Insane.
Amazing. It's still only up 13% this year. Over 6 months, it's up 130, 80 in a month. I mean, I thought this was like the poster child for being replaced by AI. And here it is, thriving.
No. So overall, I think the SaaS is dead narrative is gone. But I do think that SaaS can't necessarily go back to those ultra premium valuations that it had before. You know, like when you look at some of these SaaS names, they were trading at like 100 times forward enterprise value. Like, it's no way that you're going to be able to get that kind of multiple again.
Right.
You know, so I think there is a level where things make sense, and then you got to remember these guys 2 years ago were dilution machines. Now they're buying back their shares at a 70% discount. I mean, look at what Benioff did at Salesforce.
Yeah.
Right. Every bit of dilution that Salesforce had for the last 5 years, the guy cleared it out in 1 quarter by just doing a massive buyback. You know.
No.
So.
It's a fair point. Chris talked about Bitcoin, basically said it's a hedge right now to the treasury yields.
Well, I think ETH is pumping because of the Trump thing with Hyperliquid and basically this.
But ETH is also just following Bitcoin, I feel like. You know?
It is probably. Well, I mean, you also had Vlad on the freaking stage with the president saying that we're going to tokenize everything. You know, BMNR is running because of that too. I'm not buying BMNR again. I'm done. I will never touch shit that I don't understand.
Dude, okay, so I mentioned yesterday that me and Tanner were in a group chat with someone who mentioned buying Per. Chris was that person in the group chat. 30% yesterday because Trump mentions Hyperliquid. And then the big guy who bought Per.
Yeah, I know, Stanley Druckenmiller.
Like, it's crazy how within 3 months that was the crypto treasury to bet on, not MicroStrategy.
I got the timing wrong on that thing.
You got the timing wrong, yeah. No.
I thought because I saw so much interest in Hyperliquid, people were literally going to Hyperliquid every day to check on pre-IPO for SpaceX.
And I introduced you to Hyperliquid.
Yes,
which is hilarious because that's what got you down the rabbit hole. And then we found Per, but both of us were kind of just like, it's a crypto treasury. We're not going to do this.
Yeah. I bought some spreads on it, but I cleared them out. I took a little bit of a loss on it. I was just like, I don't understand this thing nearly enough other than there's just a lot of interest in it. And I think Stanley Druckenmiller, he bought it. Like, Stanley Druckenmiller, he buys things sometimes. He's like, buy and then investigate. Right. So I think that's the thing for him. So I think it's not like he's got conviction in Hyperliquid by any means. It's just a junior analyst came to him and probably spoke to him about it. Like, that's how he bought NVIDIA.
Yeah.
A junior analyst came to him and said, hey, listen, this NVIDIA thing. And Stanley Druckenmiller was like, okay, fuck it. Buy NVIDIA. This thing ran up to like 800 something and then he sold it. He said it was one of his biggest regrets selling it. You know?
Yeah, I think this is that clip where he mentioned it.
Yeah.
A while ago, we spoke about NVIDIA, and you had said that it would be something that you held for years. And ever since then, you held it for a while, but more recently, you've been selling it off. How much do you have left of it, and why have you been selling? Can you see yourself getting back into it again?
I've made so many mistakes in my investment career. One of them was I sold all my NVIDIA, probably in somewhere between 800 and 950. I think it's 1,300 on that stock now.
You own none today.
I own none, and I own none the last 400 points. It was a big mistake. In terms of AI, and by the way, when I saw you at that conference, which was 18 months ago, I fully expected to own it for years, but I think it was 300 and change. And as I also said at a media interview, I'm not Warren Buffett. So I thought I was going to, but what changed is it tripled in a year, and I thought the valuation was rich. We are big.
It's crazy, man.
I think
he was one of the earliest freaking guys into NVIDIA. Not early like 10 years ago, but early ChatGPT launch, recognizing this is going to need NVIDIA. And then instead of getting a 10x, he got a 3x out of it.
The problem that sometimes you run into as you get older is that you have these positions that run up 7-8 times, like 8x your original investment. And every time it goes higher and higher, you feel like this is it. This is it. Like, it's going to fall. Why? It's because you've bought into companies that have gone up so much and then have gone down. Yeah. I'll give you a good example. I was a big Celsius bull when that shit was like $20. I bought a bunch of options on Celsius. Like 2023 was the year of Celsius for me. I made a lot of money on Celsius. And when that thing got to like 90, I was just like, I've seen this story before. I cannot be in this like too long. And so I got out of it. Now, I got out of it literally almost at the exact top, and I never got back into Celsius. You know, so I'm always worried about being stuck in the next Celsius. And so one of the reasons why I underperform sometimes, like my wife's portfolio, she's up.
I know you
almost,
tweeted it. I saw because she just
she's
buys
up
and holds.
She's up 600. No. I buy and hold for her. The only reason why she hasn't underperformed like me, like I've done well. I've done like 200 and something %, right? She's done more, but that, you know why? It's because she's always at work, so I can't sell shit. I have to be like, honey, let me get your 2-factor authentication, and she'll be like at work, she'll be dealing with a patient or whatever. So I can't sell it, right? Otherwise, I would have sold half the shit she has like a long time ago. You know, remember, I'm the guy that sold Palantir in her account. She didn't want to sell.
I remember that day. Yeah.
If I didn't sell her Palantir, dude, that
dude, it was like I remember
it, 10x.
Guys, Chris had like 30,000 shares of Palantir at $9. Like he had a lot of Palantir.
Yeah. Well, it happens.
Like,
that's life.
It happens.
That's life, bro. I've done well. Otherwise, it's okay.
I don't know. You made a lot of good other calls after that. It's one of those buying and holding. Sometimes it just works. Like you have to have a really dog shit company like Trade Desk, or it's like something where it's like 5 years and nothing, you know? Otherwise, usually if the company's growing earnings, eventually the price catches up to it. And as long as that thesis is intact and it's not a cyclical business, you know, the street cares about it and they need to invest somewhere.
Yeah. I don't know. It happens, man. You know, just as an investor, what happens is you pick up a lot of scars over time and you become too fundamental with the way that you invest. And then what ends up happening is you miss out on opportunities because you don't have that optimism that a 20-year-old does. I feel like you are very lucky in that you got into the market at a time where optimism is like the big like rewards you.
It's the competitive edge.
A person,
yeah.
Right. Versus someone who's like 50 years old, who's basically seen multiple drawdowns. So you always have this like boogeyman lurking in the back of your head. Like you ask me, you ask Steve, you ask someone who's, you know, been investing for a long time, who's seen like a 30, 40, 50, 60% drawdown in their portfolio. And it's that icky feeling like, oh my God, what's going to happen? Like this is already up. The valuation is expensive.
I did experience that in 2022. Like I was down 50% that year.
Yeah, but you didn't have as much money as you have today.
That's true. That's correct. Yeah.
You know, like
it was
enough,
ugly, but
you're at the time, your net worth was that you could bounce back. Like it wasn't oh my God. But you're talking about like me and Steve, we're at a point right now where it's going to be much, much harder for us to bounce back from our portfolio sizes, you know, after gaining so much. That's the other thing too. The minute you get bigger and bigger and bigger, I mean, I'm sure that you realize it yourself. Like the amount of risk that you take has probably diminished significantly. Right.
Dude, it's why I didn't buy Per. I mean, like in 2022, I've been like, yeah, let's get, or, you know, the BM&R thing that happened. I was like, okay, if this is just another version of that, then why take the risk? It ended up being way better because Hyperliquid's now taking off. But like you get scarred by like buying shares of a company and seeing it go down more than 50%. And you're just like, I don't need to take this type of a risk or a type of a gamble on more money. Lucid's another example. That thing has been dead for years and people, you know, are still hoping that it comes back. But like the fundamentals are horrible on this.
Yeah.
So why would you want to invest?
See, and that's the problem with a lot of investing. Like if you get hit by a couple of really bad stocks and they were a meaning part of your portfolio, it really sours your future returns. You know, it's kind of like a baseball player. The more injuries you take, the worse you become over time. You know,
dude. I mean, literally at Moderna, dude. I bought it yesterday at 90. I sold it at 97 because I was like, I just made $7 on 1,000 shares. Like, I'm good. I'm happy. It went up to 170. Like, I don't even have the risk tolerance anymore to be like, I'm just going to hold it and see how the market thinks. This is the pre-market. It was like 850 or something. Or no, it was like 750. It was like an hour. I just came back from the airport dropping off my aunt and uncle. And I was like, okay, $7,000 in a minute. Like, cool. I'm fine. Like,
do you still have a Purple Biotech? If you remember, Purple,
dude, I took like a $20,000 loss on that. That was like 4 years ago.
Yeah, but I'm saying, like, you see, that's something like, because of that, you're probably less likely to be convicted in a biotech name.
Yes, 100%. It turned me off to biotechs forever. Like,
you know,
that's why Moderna still scares me, because I'm like, dude, at the end of the day, like, they need to prove there's a business there. Yeah, and as soon as it went up $1, I'm ready to get out of it. I'm like, all right, take me out. And then I can only imagine the people that got in at like 100 and it goes up to 170 and they didn't sell and now it's back to 130 today. Like that, you can only do that if you believe, like Rocket Lab. The reason Matt can hold it on a 50% drawdown is because like he really is going to hold it for the next 10, 20 years.
And his cost base is like $4.
And his cost base is $4. Otherwise, you buy that shit at 150, Rocket Lab goes to 70. I mean, that could turn you off from the entire stock market experiencing shit like that.
Yeah.
Like no one wants to lose 50% of their money in 2 weeks off this like candle just going down on their screen.
Yeah.
So I agree.
mean, that's why BM&R is hard for me to like get behind now. Like I just can't do it. Like I've lost money. Like I kid you not. If you look at my portfolio returns, like I was golden that year.
Oh, I know. You show. It was a 6-figure loss. It was ugly. I remember. It was bad.
It was like, like what am I doing here? You know. So it is what it is. But that's the thing. Like this is how the market works. You make your money places, and you know you got to have your conviction. Now, one thing I realized that when I do have strong conviction on something, I don't mind really going a little bit deep into it. You know, and that's actually worked out really well for me over the last few years. So I'm just going to keep leaning into what I know, refine that strategy. I am your mean reversion guy. If you ever need a mean reversion guy, you want to have that discussion, you come to me. I'll tell you whether or not this stock or industry has the potential to recover. Because I think I've proven myself based on TFC, based on all the cruise lines, UNH, ServiceNow, that I know what I'm doing when it comes to mean reversion. So I think I'm just going to stick to my lane and just play those mean reversions.
Look, if anyone has a mean reversion play, which to define it, it's a stock that was here, it goes here. You think it went from here to here for no reason. You think it's going to go back here and you're going to ride the upside. I think you tweet at Chris and just ask, what do you think about this? Because that is right. You like finding the dislocation in the market for alpha that's misplaced because of a drawdown has been something you've been relatively good at over the past couple of years.
Yeah. Yeah. And I've done really well because especially when it comes to like option strategies around it, I think I've got it nailed down. Like when I first started doing spreads, especially the TFC one, I was just like, God, Amit, look at this. This is so mispriced. Remember that?
I know that's what got me into options, but I wouldn't have done my Robinhood options if I didn't learn about options from TFC. And TFC, we ran it from 27 to 45, which was like a 5x on the actual spreads.
Yeah. 500% return in a year is not bad at all, baby. I'll take it all day.
But it required a lot of risk. I was learning about AOIC losses, and I'm just like, what the hell is it? Like I was learning how to read a bank's income statement. Like it took a lot of like, you got to care about the company. Because if you're betting on it to go back up after the market said we're taking this down 30%, you're saying the market's wrong. And that's usually not easy to say because a lot of times the market ends up getting it right when there's like really bad results or bad sentiment and all this stuff, especially in a sector like finance, right? Robinhood was stuck at 7 for 2 years.
It was down to 50% drawdown. Robinhood was down to $7 a share. I still remember when you called me and you were like, I'm doing Robinhood spreads. I'm like, how much? And the number you told me, I was like, I created a monster because if this does not work out, Amit's gonna be wiped out. But that was your moment. That was your moment. All right. Well,
all right, guys.
See you later, brother.
Thanks so much. Appreciate you all.
Tell Chad I said what's up. Tell him like, hey, Palantir needs to get their customer count up. But I'm rooting for you. I'm rooting for Palantir to get their customer count up, and I think that they're gonna do fine. You know, so.
Yeah, it'll be a good discussion. That episode will be out next week. Thank you all for being here, Chris. Thank you for the explanation on all this bond deal stuff. I know a lot of us, including myself, are learning it in real time, so it always helps to have this information out there for free for everybody to get some more details on this.
Yep.
Thank you, everybody. See you guys tomorrow on the Market Open. Bye, everyone. Have a good one.